Welcome to another episode of Healthy, Wealthy, and Wise Retirement Podcast, where certified financial planner Lauren Sherman shares thoughts on having a healthy mind, body, and spirit, an abundance of wealth inside portfolios and out, and lessons learned from clients and mentors over the years.
Welcome back to another episode of the Healthy, Wealthy, and Wise Retirement Podcast. Last time, I left you on a cliffhanger with part one of our annuity conversation. After that, I received so many calls and emails begging to release part two early so that you could hear the rest of the story. But I had to stick to my guns and wait the 2 weeks to release on schedule. Of course, I'm sure you know that's not quite true. And if you're ready to move on from annuities, we will have a fresh new topic coming up in our next episode. But hopefully you can find this two-part series helpful and you can find at least a few key takeaways that you can put into action. Let's take a brief moment to recap where we are at so far, and be sure to check out last week's episode if you missed it. We started off by saying that every annuity falls into the category of an income annuity or a deferred annuity. We explained that income annuities can be either immediate or deferred. They can also cover one spouse, both, or have other considerations like how long they are guaranteed to pay out, or whether payments go up each year or remain level. We also covered the first type of deferred annuity with the fixed annuity. These pay either a declared rate for the duration of the contract or a new rate is declared each and every year depending on which type of fixed annuity you select. And we finished up by talking about indexed annuities with all of their available crediting strategies and why their increased flexibility has made them a popular retirement solution. We are going to jump in today with variable annuities. Variable annuities differ from everything we have covered so far in the sense that they are comprised of underlying investments that are directly invested in the market, typically via mutual funds, so they can go up with the market, but they can also lose value. So you still have a commitment of a certain number of years, and you still have tax deferral and the ability to annuitize your contract for income, but traditionally, you don't have the other moving parts since you're directly invested in mutual funds. Often, the pitch for variable annuities versus investing in the same mutual funds outside of the annuity is that they include a death benefit and often an income rider. Once again, to reiterate what I mentioned in our last episode, often variable annuities have been sold rather than bought. In the past, and unfortunately still often to this day, variable annuities have been marred with high fees and expenses. You might pay an ongoing mortality and expense charge to the insurance company, another charge for any riders, a fee to the advisor, and typically high expense ratios within the mutual fund lineup. All in all, these often add up to 2% or more, and it's not uncommon to see fees north of 3% with variable annuities, which are all costs we did not have to worry about in our previous annuity types that we covered on our last episode. 2 or 3% might not sound like a lot, but this can be disastrous to a portfolio over time. Today, there are variable annuities that have stripped out some of their fees by structuring the contract more similar to that of an indexed annuity. These are more reasonable and could make sense to consider, but I'm always looking at variable annuities with a critical eye as they often have high fees buried within their contract. From my vantage point, variable annuities are not worth spending too much time discussing as they end up having the same problem we talked about last episode, and that's that when you try to do too much, you don't end up doing anything particularly well. For example, these contracts shoot for market upside, but then they don't provide market downside protection either, which should be a big draw to any type of annuity from a diversification standpoint. Along the same lines, many offer a death benefit and an income rider, but these typically eat into your actual account balance. And once again, you don't end up particularly well off with any of the three. And any of the three meaning your death benefit, your income balance, or your account balance. And finally, when you wrap high fees and expenses around all of this, then it's really hard to get behind the idea. Let's do a quick recap for a moment. So far, all of the annuities we've discussed, including on our last episode, are meant for either growth, income, or a combination of the two. We will finish with one last type of annuity that serves a different purpose altogether. Then we will close up by answering 3 annuity-related questions that we are asked from time to time. This last type of annuity we will call the long-term care annuity. There could be a few different names this type of annuity goes by depending on which insurance company is offering it, but this is a fixed annuity that offers some type of long-term care benefits. So, from a big picture perspective, these fall into the deferred annuity umbrella. You could also call them fixed annuities with a long-term care rider, but I think they deserve their own category since they serve such a different purpose. Instead of seeking growth or income, typically a long-term care annuity will offer protection of the amount you put into the contract, and its primary purpose, it's designed to give you added benefits if you have healthcare needs, specifically related to home care, assisted living, nursing home, and so on. So not to be a broken record, but long-term care annuities have many of the same features we've talked about earlier. A commitment to a certain duration of years, tax deferral, protection from market losses, and so forth. One major difference is that you cannot simply sign up for this type of annuity just because you like the benefits. You have to qualify for it by answering health questions and going through an underwriting process where the insurance company determines if you qualify or not. If anyone listening has ever been through the process of qualifying for traditional long-term care insurance, you know that it can be a pretty intense process. The insurance company may review your medical records, conduct a memory test over the phone, and even send a nurse out to your home for a complete checkup. In fact, often retirees don't think much about needing any type of home care or nursing home type of coverage until they have already had some type of health scare. So often in these cases, it can be challenging to get approved going this route of traditional long-term care insurance. So back to the long-term care annuity, one major benefit of going this route is that they have a simplified underwriting process that is not near as intense as traditional long-term care. For those looking for some type of coverage but have not had a perfect health history, often this could be their last option where they can still get approved. On the flip side, even those with great health often go this route, in large part because it's not a use it or lose it situation like traditional insurance. With traditional long-term care insurance, you either use the coverage, which in that case you see a clear benefit to purchasing it, or you lose it, as they say, by passing away without ever seeing any benefit from all the premiums you've paid. This is true of all traditional long-term care policies unless you add a rider that offers a premium refund, but this is rarely added as it dramatically increases the premium. I know I'm jumping back and forth a bit here, but this use it or lose it mindset is not the case with a long-term care annuity. If you pass away and the funds go unused, then whoever you have listed as your beneficiaries will receive the full remaining account value, which would include any interest you may have earned over the years as well. Aside from using the money to pay for long-term care needs or passing it to beneficiaries upon death, a third option is to use the money to fund your own retirement income needs. Of course, if you do this, you are reducing the long-term care benefits that you still may need, but situations change, and these annuities do have the flexibility to get your money out while still living, which once again is a departure from traditional long-term care insurance. One last benefit I will mention, since we should always be merging our financial planning with our tax planning, the Pension Protection Act states that any payments received from a long-term care annuity that go toward qualifying expenses are going to be tax-free. In order to be a qualifying expense, this simply means that it goes toward long-term care costs like we mentioned before, home health care, assisted living, nursing home, or any other related expenses. So really, this would even include home modifications to make your home more livable, such as adding handrails, a ramp, or any other number of modifications. It would also include related expenses like physical therapy, temporary prescriptions, and so forth. I've thrown an awful lot of information your way with regard to long-term care annuities, so let's walk through a scenario to get a feel for how this works in practice. I just recently illustrated this for a client named Marilyn, So I'll change the numbers up a bit and leave out her last name. But let's go with Marilyn for our example. So Marilyn has a little shy of $2 million in her portfolio. We allocate roughly 10% of this to a long-term care annuity. And while she still has some health issues, none of them were chronic or debilitating in nature. Let's pause here for a quick moment, because as I mentioned before, that these contracts are easier to qualify for than other types of insurance. Part of the reason for this is that you are putting up a chunk of the money right out of the gate. So the insurance company is not taking on 100% of the risk, meaning they can be a little more flexible with their approvals. Additionally, remember the insurance company is going to pay out a lot if someone ends up needing a long stretch of home care, assisted living, a memory care unit, and so forth. So when they underwrite for these contracts, they are looking at conditions that could be debilitating for a long time. They are not underwriting for conditions where traditionally a person would die from. Think of this a little bit as the opposite of how they underwrite or look at life insurance. I've had clients in the past who have had some pretty serious heart issues, and they were surprised to find out that they actually qualified for coverage. In some cases, they even had previously been declined for life insurance or traditional long-term care insurance. So that's something that jumped in my mind as I remember this conversation with Marilyn. To be blunt, the insurance company is not underwriting for conditions that often lead to death, but instead looking more at chronic conditions that would require additional care. Back to Marilyn. We placed $200,000 of her portfolio into a long-term care annuity. This was a 9-year commitment where she could take out 10% per year without surrender charges. But this was a moot point, as the plan was to keep the contract forever and either use it toward the end of her life for long-term care expenses or to pass it along to beneficiaries. Or potentially both. If she only needed some of it to pay for long-term care expenses, then the remaining amount would still go to her kids. In this scenario, Marilyn still has her actual account value of $200,000, but she immediately sees an additional value designated for long-term care needs that is triple that at $600,000. Her long-term care value is always going to be triple her account value. So as her contract grows at a guaranteed 2% per year, her long-term care value continues to go up with it. And quick side note here, Marilyn's rate was 2%, but this will vary according to rates at the time and the age in which you start the contract. So even though she started at $200,000 and $600,000 for account values, we looked 25 years into the future to get an idea what values would look like when she would most likely need the coverage. At that point, Marilyn's $200,000 has grown to about $328,000. And her long-term care value has grown to just shy of $1 million. That $1 million that is there if needed, that's created a pretty good protection around the rest of her assets. Or living in Iowa, the idea would be that if we sold some of the livestock in order to put a fence around the farm and protect everything else. Now, let's say that Marilyn then needs care for the next 6 years. Her initial $200,000 would pay out, along with the full $800,000, all tax-free without paying anything on the gains. In contrast, self-insuring certainly has its place and can be a viable option in itself, but for those who self-insure, they may end up having to pay long-term care costs from their portfolio withdrawals, which could lead to paying taxes on the gains. Or if taken out of an IRA, this would increase their income and therefore their income tax. At the time of this recording, there is still some tax deductibility that we can accomplish when we are self-insuring, but it's not going to be near as favorable as what the Pension Protection Act offers. And anytime we increase our adjusted gross income, we have the potential for upsetting other tax considerations. This could be quite a long list, but a couple that often pop up would include, obviously, your income tax rate itself, your Medicare IRMA rate, or your capital gains rate, just to name a few. I won't go into more detail on this for today, as we use technology that handles a lot of this heavy lifting for us when it comes to balancing tax brackets and other tax considerations. And quite frankly, I'm afraid I'll lose listeners if I get too detailed and don't wrap this up soon. Now, I can't close up our talk on long-term care annuities unless I cover some of the downsides as well. Of course, to start with, these contracts require a time commitment, just like many of the other annuities we've talked about. If you bail out early, you will have to pay early surrender charges and you're not going to be happy. Additionally, you are going to receive a fixed rate, probably pretty similar to a CD, depending on where rates are at. You could be higher, you could be lower. At least at the time of this recording, it's pretty tough to see rates lower than a CD, but of course that could change. So that might be one of the bigger downsides. If you see the rest of your portfolio going up, maybe even by double-digit percentages when the market is cooperating, then you're going to look at this contract and feel like you're missing out. And I guess it's hard to call this a downside, but one of the toughest situations is when someone really gets excited about the idea of a long-term care annuity, but then they are unable to qualify for it. Because remember, this is something you have to get approved for through health underwriting. I will throw in one last downside specifically for those who are comparing this option to traditional long-term care insurance. The long-term care annuities do not qualify as what's called a partnership plan. Being a partnership plan is a designation that a plan gets. It's not a separate plan altogether. But this comes into play if you were to spend through all of the benefits of your contract. Being tagged as a partnership plan, this protects some additional assets from Medicaid consideration. I covered this in more detail on a previous episode titled 6 Long-Term Care Strategies for Your Retirement. So if you want more details on partnership plans or just long-term care planning in general, check that one out or print off the cheat sheet for reference. I'm sure I missed some things, but that will have to do it for our overview of annuities. And if you include our last episode, we covered income annuities, fixed annuities, indexed annuities, variable annuities, and of course the long-term care annuities we just discussed. I'm going to close up today's podcast by answering 3 questions that come up pretty regularly, but I wanted to wait until the end as they apply to all of the annuities we've discussed so far. Our first question that comes up in one form or another is, how are annuities taxed? Now, if we're talking about qualified funds, which this refers to retirement plans like IRAs that you have not yet paid taxes on, you're really not going to see a difference between how an annuity is taxed versus an IRA held elsewhere. For both growth and upon death, you're going to see the same tax treatment. When we look at non-qualified funds, which would be your accounts that you have already paid taxes on, so this would include what sits in your checking account, perhaps you have a brokerage account somewhere. You often hear these referred to as taxable accounts too. With a non-qualified annuity, you are not going to pay taxes until you make a withdrawal. So in this sense, you can leverage some tax timing strategies, but you're also paying regular income tax on any gains. And gains have to come out first. You can't take out your principal first, leaving your gains in the contract. With non-qualified funds held elsewhere, you may pay regular income tax on gains, for example, when your bank credits you interest, or you may pay the short-term or long-term capital gains rate upon withdrawal or sale of a holding. This would be like if you bought a stock and held it for a few years, you don't have to realize that gain until you sell it. And at that time, you pay a long-term capital gain, which will almost always be lower than an income tax rate. Additionally, you could offset the gain by also selling another holding at a loss during the same year. So there's some tax strategy there as well. To reference another past episode, I covered this in much more detail in an episode titled Tax Harvesting for Year End. And a last key consideration on the taxation of annuities is that when looking at non-qualified funds, they do not receive what is called a step up in basis. You can think of a step up in basis as getting a fresh start. So if you pass away with $2 million in your Charles Schwab account, let's say that it's all taxable, so no IRAs, the basis for tax considerations for your heirs would be $2 million. This can be particularly beneficial if the account started at a fraction of that. Let's say you started with $500,000 and it grew to $2 million. That's $1.5 million in gains that your heirs won't have to pay taxes on. There still may be some estate taxes to consider, but not capital gains. In the same scenario with an annuity, it would pass to your heirs, but the contract would keep the same $500,000 as what they refer to as the taxable basis. So the additional 1.5 would be taxed at your beneficiary's income rate when they withdraw the funds. It's been a political talking point to get rid of the step up in basis altogether, but until then, this is a good reason to use your annuities for income while living before using other assets that receive a step up. And really, annuities are designed for income, so this makes sense. Let's move on to our second question. So a second question that comes up refers to an annuity's ability to pay. Often, the question comes in the form of, is this FDIC insured? The short answer to whether annuities are FDIC insured is no, they are not. However, they do have other safeguards in place. For starters, whereas your typical bank or credit union will only keep about 10% of their assets in reserves, you can look at an insurance company's solvency ratio to see not only that they have 100% of their assets on hand to cover future obligations, but how much in excess they have as well. This makes sense as banks are in the business of lending out money, which is not what insurance companies do. But if everyone needed their funds back all at once, it's nice to know that the dollars are there when it comes to insurance companies. Additionally, each state has an insurance guarantee association. This is really important as not a lot of people are aware of this, but this means that other insurance companies will pick up the slack if one company cannot fulfill its obligations for some reason. You might wonder why that would ever happen. So to give you one example, when nursing home insurance was first introduced, insurance companies were not quite sure how to price the product. Also, they offered plans with lifetime benefits, so there was no cap to how much they would have to pay out. If an insurance company expected to pay out just 2 years for an average nursing home claim, and it turned out to be twice that, and perhaps twice as expensive, you can see how that would put a hit on their financials. In these cases, you may remember insurance companies changing names, but the contract continued to be honored due to these safeguards. Today, insurance companies are considered one of the safest places you can put your assets, particularly when looking at highly rated companies who have billions of dollars in assets. So while there are plenty of other variables to consider when looking at annuities, and we've already discussed quite a few on today's show, I don't view the safety of the company as an overly concerning one myself. And last, for our third question, I cannot conclude a talk about annuities without bringing up commissions. From a transparency perspective, commissions should always be addressed without being asked. So that's the idea behind this quick overview and my thoughts on the topic. This roots back to what we touched on earlier, that often annuities are sold rather than bought. I don't think people have a problem with paying a fair rate for a service they receive. I think the bigger issue is with the transparency of the conversation and how often the one making the recommendation has a pretty big bias and frequently is selling a product rather than creating a well-diversified portfolio. With that said, insurance commissions on annuities can vary from as low as 1% to as high as about 7% in some cases, which is typically paid out in the first year only. One positive here is that this is already built into the contract. So whether you purchase a plan directly from an insurance company or through an advisor, the plan you receive is the same either way. The only time you will see the commission come right off the top of your investment is in the case with variable annuities. This isn't necessarily a bad thing as it's a transparent way to show the cost. So this isn't necessarily a knock on variable annuities, but it's typically all of the other fees included with variable annuities that cause me to avoid this type of contract. I think it's always helpful to have something to compare fees to as well. In the case of an annuity where a 5% commission comes out, whether directly, as is the case with variable annuities, or indirectly with other types, what are you already paying that you can compare this with? If you are already paying an advisor 1% to manage your assets, and you have another 0.5% in expense ratios for those same investments, that's 1.5 all in. In just 4 years in that model, you've already paid more than you did with 5% upfront for the annuity. Of course, everything is relative, and the main point to me is that you are receiving value in return for your fees. I won't harp on this any longer since, once again, I have a full episode discussing fee structures that I will link in the show notes if you want to go back for a deeper dive. And I'm going to close out this talk about annuities the same way we ended our previous one, titled Annuities, the Good, the Bad, and the Ugly. If you are adding an annuity to your retirement plan, you should have a conversation about its pros and cons, any fees or moving parts, and the duration of your commitment. Just as importantly, you should only add an annuity when you and your advisor understand how it fits into your overall plan. This involves understanding your goals, risk tolerance, as well as the location and purpose of other assets. When used correctly, annuities can be the perfect puzzle piece completing your retirement picture. Used incorrectly, they can look like someone tried to hammer a square peg into a round hole. All right, it's time to take a deep breath and let it out as we've finally reached the end of our two-part chat titled The Many Colors of Annuities. I will be back with a new episode in just 2 weeks. Until then, check out the show notes if you'd like to schedule a call for your own complimentary retirement risks analysis. And as always, find past episodes at healthywealthywiseretirement.com.
Thank you so much for listening and supporting this podcast. If you've enjoyed listening, we would love if you took a quick moment to leave an honest review. Of course, we're shooting for 5 stars, but if you have suggestions to improve the show, we would love to hear from you too. Just click on the podcast name, Healthy, Wealthy, and Wise Retirement Podcast, and scroll down to ratings and review. Thanks again for your support, as this helps us reach a wider audience and help even more retirees just like you. This podcast is for entertainment and informational purposes only and is not intended as a specific tax, legal, or investment advice. Lauren Sherman is a certified financial planner and co-owner of Integrity Wealth Management, an investment advisor serving retirees in search of their own healthy, wealthy, and wise retirement lifestyle.